This year's drop in the stock market caused a lot of stress and panic for investors. A lot of people are selling off their investments. But that is basically the worst thing you can do right now. If you decide to take your money out of your investments and put everything in cash, at least do it the smart way. How? You will hear it right here on the Money Network, right after you hit the like button for the YouTube algorithm. Join the Money Network. There's already 1,730 of us, and the network keeps growing and growing. $740 billion. That is the total amount of outflow this year alone in long-term US mutual funds. These mutual funds have been losing assets under management for years now. But now the outflow of $740 billion before the end of the year even is the biggest drops in funds under management in the last 8 years. And do note, this is not due to market fluctuations. This is not due to money losing value or investments losing value. This is pure outflow. This is pure money taken out of the investment accounts by the investors. Investors are obviously worried about the returns of their mutual funds and the performance of their fund managers. The trust they have in those people is diminishing fast. The mutual funds are on track to lose over $1 trillion in 2022. And even though the market is down 18% year to date, this is not the reason why investors are taking out their money. While some of the outflows are actually leaving the market and are putting cash, those are the people that are afraid of the markets, the majority of the money flows to ETFs, exchange tracked funds. These are passive funds, basically the same as mutual funds, with the biggest difference, the way they are managed. Mutual funds are continuously managed, meaning that a fund manager is working full-time to buy and sell stocks inside of the fund. Every time they think a sale is required or a buy is advantageous, they will do so, all to get the best return for the investment while keeping the investment risk as low as possible. But by doing so, they actually charge rather high management fees, which in their turn eat away at the return of the investor. The biggest winners in this case are not the investors, but are the fund managers. Because even in bad times when the stock markets go down, you are still paying your management. But luckily in recent years we have ETFs. These passive funds are only managed once or a few times a year, but not permanently. And this negates the management fees, resulting in very low running fees. The average cost of a mutual fund is 1 to 2%, 2.5% maybe, while ETFs often range from 0.1 or lower to 0.8% a year. Personally, I am a very big fan of ETFs. It is a very easy way to invest in a diversified portfolio of stocks without paying a lot of fees or spending too much time doing the research yourself. You're just really buying the whole market or a whole sector. I'm a big fan, but I am not the only one. Up until today, in 2022, already around $500 billion have been transferred to ETFs, passing the total amount of 2020 and following the record of 2021 of $935 billion in inflow. That is a huge difference compared to the $740 billion outflow of the mutual funds this year. It's actually a shift from one way to another of $1.2 trillion. To be honest, that $1.2 trillion doesn't seem like a big number, but $1.2 trillion is a huge amount of money. Here is a visual to show you how $1 trillion would look like in $100 bills. Next to all of these piles is a truck, and a human also, almost invisible due to the scale of it. $1.2 trillion is a lot. I think that in the coming years we will continue to see outflows in mutual funds and the growth of passive ETFs as well. Even in times when the markets are performing badly, there will be inflows in ETFs, as we have seen in the past years. I do, however, notice that bigger banks and investment managers are also exploring the ETF market. Often they offer ETFs in a global management portfolio to their customers. And these products contain one or several ETFs with low costs and are advertised as such. But the ETF portfolio management also comes with a cost. And this cost is often a multiple of the underlying ETF fees. And of course, it's pure profit for the managers. So if you are looking to invest for yourself, read up on ETFs. If you're starting out, it's the best thing you can do. If you spend just a little of your time to educate yourself on ETFs, you will prevent yourself from paying high management fees on your investments over time. The initial time investment is a very small price to pay that will earn itself back tenfold in a matter of a few years. Always be wary on how you invest. Always make sure that your portfolio is built defensively. It's your hard-earned money, so protect it, but also make sure that it works for you. Start with a good investment foundation, and once that is into place, you can then start adding details to your heart's content. These details or preferences are not required. In my opinion, a solid base is already good for the majority of investors. The more details you try to fill in into your portfolio, the more upkeep it will require. So if you need help learning how to invest, write a comment down below this video and ask for help in the Money Network. Also, don't forget to subscribe to the channel, because there's a lot of videos already on how to invest and what you should be looking at if you want to invest in certain ETFs. Be sure to check those out. You can also reach out to me directly. Details in the description below this video. We thank you so much for watching, and until next time.